Darius. Looking forward to your thoughts on what we've seen over the last week or so. I know we were chatting before the show, and there seems to be at least a growing consensus that we may be in some kind of regime change here. We are seeing a variety of signs. One thing that I've really picked up on over the last 2 or 3 weeks is we are in one of the most reflexive markets that I've ever seen in my career, going back over 20 years, where you've got sort of a confluence of extreme retail investor speculation and participation in the markets. I mean, just looking at the volume of odd lot call premiums, for example, the amount of gamma in the market on some of the highest priced names, thinking sort of the Teslas of this world. And at the same time, you've got a Fed president that's been reconfirmed, or Fed chair rather, that's been reconfirmed. And I think it is often the case that when we have a new confirmation or a new Fed chair, they often like to come out of the gate signaling that they're not going to be the same as the previous chair, and or that they have their eye on the ball. And so I it seems like there was a dramatic shift in tenor in the market really since the Powell reappointment. So I think that's an important thing to notice. We've had some other really interesting market-oriented signals, like what's going on in the Eurodollar market. I know the guys over at Alhambra have been remarking on the fact that we've had an inversion further out in the Eurodollar curve, which has often indicated a risk towards the deflationary camp. And so, is that complicating views on the trajectory that the Fed might take? And, I know a large group of macro commentators have been calling for this dynamic where we may get this sort of huge energy-led uptick in inflation expectations, and that may then cause a reaction from the Biden administration and some governments. They've been sort of signaling that they won't let this inflation get out of control, or they won't allow it to dent the economy, and their willingness to add to fiscal stimulus here. And so you've got this sort of, inflation shock may actually lead to an exacerbation of the same dynamics that have led to this inflation shock. And at the same time, you've got signals that certainly the bond market and the Eurodollar market are positioning for deflation. So, I think what we're really observing is a market that is ripe for inflation volatility, right? And so I don't think investors necessarily want to be concentratedly positioned towards the inflation camp or towards the disinflationary camp. I think you want to be positioned for inflation volatility, and there's a different type of trading dynamic that lends itself to that view. So maybe I'll stop there, and maybe you guys can react to that, and then I want to share a couple of charts that we thought were really interesting from last week.
Yeah, I think we've been talking about inflation volatility quite a bit, right? I'm particularly sensitive to the inflation discussion because of my formative years in Peru. A lot of people think they understand inflation, but they don't. I mean, inflation is such a broad series of events that don't happen all at once. Canadians especially love to talk about inflation protection as their gold position. Right? It may work, gold may be there, and it will be there in certain ways, but depending, if we're looking at quarter to quarter, the ways inflation manifests in different asset classes and different commodity complexes is wide and varied, right? Gold has been flatlining this whole year. You had energies going up. You had, grains at times, we're short the grains, at times we're long the grains. Like recently now we're back to being short energies after what happened last Friday. And so when people ask me, is it going to be, persistent and pervasive over the next decade, or is it going to be a transitory inflation? The answer is yes. The answer is that inflation decades are what you said, Adam. It's a decade of inflation volatility, thrust upwards of massive volatility spikes with deflationary busts and another round of inflation, deflationary busts. And from point to point, like decade of the 70s, commodities generally were up 800% for the decade. So you use this concept of like, look, commodities are great to hedge that decade. The problem is the average investor, the average advisor, the average allocator will be fired or just have weak hands in those moments of downfall. So I think inflation, unlike growth, requires a bit of a Midas touch. You need to be active in order to protect and manage that volatility of inflation, rather than just thinking a single passive position in your portfolio is going to do it.